So this is going to be your Phoenix metro area East Valley housing market update. We're going to talk about the recent inflation news that just came out this morning. We're going to talk about average and median home sale prices, and also have some interesting news for you about home closings and what they look like this year compared to last year. Let's get to it. All right, let's start out with the Crawford Market Index. This is released by the Crawford Report, and this is trying to give you a measure of, are we in a buyer's market or are we in a seller's market? The value of 100 on this graph here is a balanced market, actually anywhere from 90 to 110. Okay, if we're below 90, we're in a buyer's market. We're above 110, we're in a seller's market. So this starts out in 2020 in this graph, and as you can see, we were well into seller's market territory for a lot of the last few years. But starting this year, as we all know, that didn't stay around forever. The Federal Reserve started increasing interest rates, trying to get rid of our inflation, and that has really caused these prices just to go down like crazy. So we've gotten more and more towards the buyer's market. We went ahead and passed the balanced market. And if you look at these cities here, each line represents either Chandler, Gilbert, Mesa, or Queen Creek. They are starting to level out. So we might be seeing a bottom on that. I hope we are. Things are stabilizing a bit, but we'll see where things go in the long run. We actually saw a positive increase, meaning a move more towards a balanced market for Mesa, Chandler, and Gilbert last week. Queen Creek did continue to drop a little bit, but again, we are still seeing that curve flatten, as you can see on this graph here. Other interesting news, residential rentals for the area are up 60% from where they were last year. There are 60% more rental listings, homes trying to be rented out, than there were last year. This generally would put pressure on rental lease prices to go down. And I've got this graph here showing the lease prices by quarter, the median lease prices. Unfortunately, we don't have the rental listings graph to compare, but this will still give you an idea of the effect it's having. So in 2015, we had a low of $1,275, and this is for only single-family homes, only in the East Valley. So a median lease price of $1,275 back in quarter one of 2015. We saw a high last quarter of $2,375, so a huge jump in price, nearly double. And then we see that price is backed off to $2,300, and this could be due to a number of factors. But the most important one driving this is obviously a huge increase in rental listings. Home affordability is still an issue. Home prices are coming down. We are seeing a flood of new resale homes hitting the market, but with interest rates so high, it is difficult for people to buy homes right now. And so usually you'll see those people move into rental properties. But with such a huge increase in the amount of rental properties on the market, that is keeping competition in the market, meaning that prices are having to go low. So right now we're seeing the odd phenomenon of rental prices and resale prices for homes decreasing because there's so much competition in the marketplace. We'll see what the long-term trend shows, but just some interesting data to show you a weird thing going on in our market right now. I did want to talk about, for a brief moment, the changes in the closings that have happened month over month. And I wanted to show you what this data comes again from the Crawford Report, but it's in spreadsheet form, and I wanted to show you this in graphical form. So I created this little graph here in Excel. We've got two lines. You've got the orange line, which is the resale closings. You've got the blue line, which is new build closings. And what this is measuring is this month of this year, so August 2022 versus August of 2021, and so on. The first point is August of 2021 versus August of 2020. All right, so the orange line has been coming down over the course of this year, which we would expect. We've seen a lot more homes hitting the market. We've seen demand drop off because of higher interest rates, and so we're seeing fewer closings. We are actually at negative 38%, so 38.3% fewer home closings this August versus August of 2021. On the flip side of that, on new builds, most of this year has been negative. We have seen fewer new home closings versus last year. And that's expected because home builders have been having a hard time getting labor to build the homes, getting the materials to build homes, and demand has also gone down on them as well. So they are being affected by that to a degree. So been negative for most of the year, but this last month, they were up 7.64% over last year. And you can see this spread between new home builds and resale is just really starting to separate significantly. That's likely due, in my opinion, to the fact that there's not a lot of new building going on right now, and there are a ton of new homes. So what that means is we have a smaller supply of new builds and a larger supply of resale. And if you are a buyer coming into the market, which there are still plenty of people buying, most buyers would prefer to buy a new home if they can. And because the new builds have a smaller supply, there's going to be people that are going to be buying most of those up, whereas when you have the resale homes and you have so many of them to choose from, not as many buyers are going after all of those. And we are seeing many of the metrics to support that, but it's just interesting to see that big of a spread between new build and resale. We'll see what continues as time goes forward. Now, let's talk about the average sales price and the median sales price for the month and what's been changing. Just a quick refresher, I know most people probably know this, but median is meant to give you the middle price in a range of data. So half the sales would be above the number measured and half of them will be below, whereas the average is taking the total number of homes considered, adding them up and dividing them by the number that were there. The reason the average is a problem is because it can be skewed up or down depending on if you had a ton of higher than normal priced homes or skewed down if you have a ton of lower than normal priced homes that were sold. So let's look at 2012 to 2022 just to see where things are going. And this is only for single family homes, normal sales, meaning not foreclosed homes, not bank owned homes, and only in the East Valley. So the low on the average chart was 196,000 back in February of 2012, whereas the low median was 160,000 back in 2012. So that's a difference of $36,000. And as a percentage, that's huge. The average closing price high on this chart is 630,000. That was back in June. 630,000 average sales price back in June. Then we've got the median price high at 560,000 back in May. So $560,000 monthly median sales price back in May. That's a difference of $70,000 between the median and the average. Again, as a percentage, huge. Really important when you're looking at statistics and you're looking at what's data to try to get an idea of what's going on in any marketplace. Definitely make sure you see the median and the average. The drop-off average is currently now at 600,000, so a $30,000 difference. It's roughly 5.87% off the high. The median is currently at 520,000, so a $40,000 drop-off. It's about I think it's 7.1% change. So 7.1% drop on median prices versus a 5.8% drop in average sale prices. Obviously, we're going down. Everyone knows that, but important to really use the two of them to see what's going on. Most industry leaders are expecting home prices to continue to go down throughout the rest of this year at a slower rate. All the appreciation that we got this calendar year, meaning since January of 2022, they are expecting that to be completely eroded. It has not completely been eroded yet, depending on which market you're in around the country, but they are expecting that to go away by the end of the year. So we'll see what happens, but that is the median and average sale prices. Now, because this huge run up, that was a big driver of inflation. And as we know, the Federal Reserve is trying to get rid of inflation as quickly as possible. And to do that, they have raised interest rates. One of the metrics they look at to choose how much to raise interest rates or what to do is the Consumer Price Index. This is the U.S. Bureau of Labor and Statistics. CPI went up 0.1% last month. That was a surprise. Everyone was expecting it to go down. July was flat. And we didn't see any inflation in July. Earlier months this year, we saw more than 1% in several months. And that's really unhealthy because we usually want inflation to be somewhere around 2 to 4%. That's usually the target that the Federal Reserve is looking to hit. And obviously, when you have over 1% in 1 month, that's a real problem. All right, so they've really raised rates to try to bring this down. But when you had flat last month and you've had rates continue to stay higher, everyone expected this month to go down, but it went up. Now, 0.1% is not a huge increase up, but it is still a step in the wrong direction. If you look at this column here, August 2022, on the left here, it shows you which items are included in the CPI and what effect they had. The biggest driver looks like it's this energy services, so electricity and gas utility services for your home really pushed us up quite a bit. We did see, luckily, a big drop in energy for commodities, so gasoline and fuel prices dropped dramatically. And we'll hopefully see more of a movement down next month, but This is likely to lead the Fed to possibly take stronger measures than they were planning on with interest rates. We do know that they were planning to raise rates throughout the rest of this year, but they may be raising them higher further faster than what they were planning on as of this news. I certainly hope not, but whatever they do, I'll be sure to keep you informed. So if you like this video, please leave a like. Let us know if you have any questions about what we've covered here in the comments or anything you want to see me cover in the future, and I'll be happy to do that. Thanks for watching.